Unity stock price is down, folks, due to a recent announcement that this company made. Is probably the most stupidest thing I've ever heard in my life. The stock price is getting penalized for it, and rightfully so. We're going to investigate this business. We're going to figure out what they're doing right and what they're doing wrong. And if you're new to the channel, my name is Leo. I'm a value investor, and I love investigating companies from a numerical perspective to try to figure out intrinsic values to help you understand whether you're buying a company for a great deal or not. So with Unity, currently the stock price is $36.02. We've seen some massive drop-offs from Tuesday to Wednesday due to this news. And if you're wondering what that news is, they've made some changes to their fees. Essentially what they're implementing, or they're planning on implementing, is a fee structure where if you install a game, the developer will get charged for that install. And guess what? It stacks in a way where if you're the developer and I download your game, I play it, had my fun, I said, you know what? I don't want to play this game anymore. Delete it off my phone. Cool. Re-download it. Guess what? You're going to get charged again on top of the subscription fee that you already pay per year to use their software. So essentially, they're just trying to squeeze some new revenue. And I understand why they're trying to do that, but it's really shitty when you do that to developers, because maybe they are a free to play type game where they only make their revenue based off of like in-game transactions. So now on top of just getting dinged for the install, now you're down whatever the fee is. Let's say it's 20 cents. Well, now you're down 20 cents. It may not sound like a lot, but let's say you have millions and millions of players. Now they're all getting dinged, and none of those players, or maybe half those players, buy something in game. You're still not going to be able to recoup. Oh my God, can I speak today? You're still not going to be able to recoup those costs because of this fee structure. On top of which, take a look at this article. I'm going to show you right now. Unity is making two meaningful changes to its pricing model. First, the company is eliminating its lower cost Unity Plus plan entirely, so current subscribers will be able to upgrade to Unity Pro at the same $400 per year rate for 1 year. But after that, they'll need to shell out the full $2,000 for a pricier plan. That is absolute insanity. So you're a new developer, you're looking to get into the video game industry, you're utilizing Unity because you think it's a cool video game engine. You're paying $400 a year because you're probably a student, you probably don't make that much money, you just want to get your feet wet and figure out stuff. Now they're saying, yeah, screw you guys. You have to now pay 5 times more after a year if you want to do the same thing you were doing just last year. That makes sense? That doesn't make sense at all, because look, the developers of today are going to be the developers of tomorrow. So you want to eventually put them in a price range where they can at least experiment and figure out what their skills are. Like, especially if someone, let's say, jumps into this thing thinking, oh, you know what, maybe I want to just dabble with it and just for fun. And now you're saying, no, pay down 5 times more to have fun. They're not making the revenue to make that money back. That doesn't make any sense for the casual person that wants to use the software, and you're discouraging people from even getting into the industry, and you're really funneling, like making a really small funnel. You're essentially shooting yourself in the foot with your other competitors, such as Unreal Engine, which I'm pretty sure they just have a revenue share model. So they don't have a subscription model. They just have a revenue share, which I believe it's 5%. So you just kind of just have to share whatever you make with them. That is totally fine. And I hate when companies tack on these stupid like squeezing mechanisms. And you know what? Now they're getting penalized for it. This is why the stock price is down, because this is a stupid way to make money. I understand the install thing to a certain degree, but like shelling out and just getting rid of, I think the install thing is stupid too, but this is probably beyond stupid, because now you're just chopping off a leg of people starting off. Those people will eventually become pro developers, but you're shooting them out if you get rid of this pricing plan entirely. Also, here's the other thing. Second, Unity is implementing a fee for developers each time a game is downloaded and installed. This fee applies to those using Unity's free plan as well as its paid plan. Absolute insanity. Although the thresholds are different for the free plan, anyone with more than $200,000 in revenue over a 12-month period and at least 200,000 lifetime game installs is on the hook. That is crazy. This new fee is 20 cents per install. That is insane. For paying subscribers, the thresholds are $1. Wait, sorry. Oh my God. 1 million in revenue and 1 million lifetime installs, and the fees are smaller. It's still a bogus install. Sorry, it's a bogus pricing model. And honestly, look, here's a stock price on StockSpec. This is software I use to screen these companies. Look at this. What an absolute shit show of a company and what's going on. Basically, 52-week range, folks. $21 on the low side, $50 on the high side. We're kind of sitting in between that. But look where this company was back 2 years ago, 2021. Absolute insanity at $197. You really thought this company was worth $200 a share? For what? For negative price earnings ratio? Look at this. On the board here for the financial valuations, and if you're new to the software and new to the channel, this software essentially grades the company based off their financial strengths. 3 out of 10. Really? Really? No. A current ratio? Cool. You have a current ratio which is above 2. I love that. Revenue growth is up. Great. Your free cash flow is up. But you're sitting in $1.81 billion of revenue. Great. Your net income's in the negatives by almost $1 billion. Your free cash flow's in the negatives as well. You have negative numbers across the board. Negative return on equity. Negative free net income. High debt to equity ratio. Like, guys, in a high interest scenario where we currently are sitting in, you have most of your operations are funded by debt and not through equity. You don't want to be in that predicament. That is terrible. And then coupled with a high share dilution of 10%. So over the last 5 years, you've been holding on to this business. Guess what? You own less of this business now. You own less of this business because now it's currently sitting at 10% of more shares on the market. Does that make sense? And your share count and the share price is down. So you own less and your share price is down and you're fueled by debt in a high interest environment. That is a recipe for disaster. And plus this new fee structure that you're planning on putting in. Dear God, that hurts. That absolutely hurts. And then your return on invested capital is also sitting in the negatives at negative 23%. This company is an absolute disaster. 1 on the Piotrowski score. And if you're new to what that score means, essentially it takes a look at how the company performed from the previous year to current. We want to find companies that have a Piotrowski score of at least 7 to 9. 9 is the highest score you could possibly get. 7 is pretty good. That means that there was a general improvement in a majority of the categories, from like return on assets and so on and so forth. I can't remember all the metrics, but short story of it is 7 to 9 is a good score that you want to aim for. We're at 1. We're at 1, guys. That's terrible. Almond Z score 1.98. 1.98 Almond Z score, and what that does, folks, is that score evaluates whether the company is safe from bankruptcy. Anything above 3 is phenomenal. 1.8 to 3, 1.8 to 3 is a gray zone. Currently, where Unity's standing at 1.8 and below, or below 1.8 rather, that's where the company is in a mode of distress, and essentially they are at a risk of bankruptcy. Currently, Unity is sitting at 1.98. So you have this company that's in this very much of a gray zone of bankruptcy. It's in the iffy zone. You have negative net income, negative free cash flow, which we don't want. Like, this is like you're bleeding. This means you're bleeding. You're fueled by debt. You're diluting shareholders. And yeah, there's just so many negative numbers on the board. God help whoever bought the company at this price point. Like, my God, if you're still holding the bag up to this point, I feel so sorry for you. But if you're looking to get into this business right now, like, this does not make sense one bit. This fee structure, I think, is going to do way more bad than, like, I'm not even so much concerned. Like I said, I'm not too much concerned about the install thing just yet, because a lot of larger developers, they're going to get hit. I think really just axing out that cheap plan is probably going to do a little bit more damage in the long run, because yeah, the people that have their software out now and they're getting hit by these install fees, yeah, that's going to hurt. And then they'll probably just say, screw it, we're going to go to another engine. But now you're really shafting the newer guys that want to come in and eventually use your product. Because what's the incentive? Oh, guess what? You got to pay out through the nose. Plus, you have your install fees. Why would someone new that's starting off in video game development want to use your software? They have Unreal Engine. There's all these other softwares. I mean, I can't really name them, but there's other engines that you can use to make stuff. This company is a mess. Even if I wanted to do an analysis of try to find the intrinsic value, how can I? I got negative numbers across the board. I got negative price to earnings ratio, negative price to free cash flow. This company makes no sense, but essentially it's hardly coherent in the sense of trying to price out something where you're bleeding out. And honestly, if you're evaluating a company, you can only pretty much go based off what a positive free cash flow anyways. So like, what does that actually look like? Let's go into the cash flow statement and go on an annual basis here. But look at that. Across the board from 2018, we're sitting at negative 120, negative 90, negative 20. And these are in the millions. Yeah, until this company actually starts making positive free cash flow, that is when it's worth taking a look at to try to actually price out what this company can potentially be. But we're not even there yet. We're not even in a positive metric at all. Revenue is currently $380,500, so half a bill, 3/4 a bill, and then afterwards 1.4. Okay, so revenue's obviously increasing. It's an absolute disaster. My personal opinion, I would just stay away from this business until you see positive free cash flow going forward. But shareholders are currently not happy over the last couple of days. I mean, we're going to see how this plays out, but I think this is a terrible business to potentially get into. You might think otherwise, and you know what? I think you're wrong. So personally, I think if you get into this company now, you are absolutely foolish, and you're just going based off of. I have no idea what metric you're going based off of, but here are the numbers, folks. This is what makes sense to me, and none of these numbers make sense at all. This company makes no sense at the current time. Now, I'll revisit this company in a little while once there's some positive numbers on the board, but you can't tell me a company with a high debt to equity, negative free cash flow, high share dilution, negative return on invested capital, negative price to earnings ratio, a garbage Piotrowski score, a mediocre Almond Z score is worth looking at and potentially parking your money in. There's a lot of other companies out there that are worth your time and money, and it's not this one. If you like the software, follow the links in the description box below at stockspec.com. 7-day free trial to analyze companies quickly and effectively. And if you like this video, hit that like button and subscribe button. I will see you in the next one. Thank you so much for watching.